Good afternoon, everyone. We at Centrum Broking are very pleased to host the Q1 FY19 results conference call for Mirza International. Today from the management, we have Mr. Sujal Mirza, President Marketing, and Mr. Shyam Awasthi, VP Finance. I would now like to hand over the call to the management, followed by which we can have an interactive Q&A. Over to you, sir.
Thank you, Ankit. Good afternoon, everyone, and thank you for joining us for our con call today to discuss Mirza International results Q1 FY19. I will start by giving an overview about the quarter gone past and would be followed by detailed financial analysis given by Shyam. Our Indian branded business has achieved a 27% growth in first quarter of FY19. The footwear branded sale has grown by 21% to 87 crores, and branded garment sale has grown by 49% to 30 crores. Export sale during this year was down by 8%. We have opened 15 retail stores in this quarter, out of which 14 are the larger format stores. Today, the total number of stores is 174, out of which 23 stores are what we consider as online stores. We have launched a new women's brand called Mode, M-O-D-E, in the market, which is selling ladies' slippers, sandals. And we have diversified our product portfolio into synthetic shoes, sports shoes, PU shoes, and canvas, and some other accessories. Now I would be handing over to Shyam.
Thank you, Sujal, and good afternoon, everyone. I will give you the highlights of our financial results for Q1 FY19. The total income for Q1 FY19 is rupees 261.90 crores as against 252.14 crores in the previous year. There is a growth of 3.87% on quarter-to-quarter basis. There is a net profit after tax for Q1 FY19 is rupees 18.07 crores as against 20.41 crores in the previous year. The EBITDA for the quarter is rupees 43.24 crores as compared to 43.78 crores in the same quarter last year. EBITDA margin for the quarter is 16.51 crores, 16.51%. The export performance is the export of footwear for Q1 FY19 is 122 crores as against 133 crore in the last year. There is a decline of 8% on YOY basis. The UK market is decreased by 18%. The turnover is 72 crores versus 88 crores. And the US market is increased by 18%. That is, the turnover we have clocked 33 crores versus 28 crores last year. And rest of the world is at par. The 17 crore was the same figure in this quarter and the last quarter. Indian branded sale of the red tape and bond sheet bands for this Q1 FY19 is 117 crores. And the breakup for 117 is 87 is the footwear, branded footwear sale, and 30 is the branded garment sale. That makes 117 crores. And there is a growth of 27% in this segment, on a YOY basis. The advertisement expenditure for this Q1 FY19 is rupees 2.54 crores. It is around 2.15% of the Indian branded sale. So total advertisement expenditure is only 2.54 crores. And the net financing cost is 7.35 crores as against 5.92 crores because the loans and the total borrowing have been increased to rupees 300 crores as on 30th June 2018. The debt equity ratio is 0.54. And the net worth of the company is increased to rupees 591 crores as on 30th June 2018. We have opened 15 retail outlets during the quarter. Total count of the outlet has reached to 174. And out of this, 23 are the online, offline shops, and rest 150 are the regular shops. And with this, I'd request to please start the question and answer session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. We have a first question from the line of Shikha Mehta from Qtr1 Capital. Please go ahead.
Hello.
Hello.
Sir, I had a few questions. Could you tell us about your hedging policy on Forex?
Hello.
So, Shikha, what we do is whenever we get an order, we book that much currency for the date when it's supposed to be delivered. So we forward book it. We don't hedge in general extra amount. So that way we keep ourselves covered from any unusual changes in currency.
All our exports are 100% covered by the forward contracts.
Right. So could you also give, hello?
Yeah.
Yeah.
So could you give details on the margins on leather sale? Because I see they've reduced substantially.
The leather sale actually in the tannery, the capacity utilization is on the lower side. So in the tannery, we get either we are on the break even. We don't get any margin. We are not because our leather capacity utilization is not so high.
So what is the plan on that going forward?
Going forward, as our leather business is growing, the red tip sale is growing, so that will, increase the capacity utilization of the tannery, and that will convert the tannery into the profitability in the near future.
All right. So could you also give a breakup between red tape, on street mode, etc. in volume and rupee terms?
Yeah, total branded turnover is 117 crores. Out of these, 30 crore are the branded garments.
Right.
The rest, 87 is the branded footwear.
So
and
could
out
you
of this,
break up within the brand?
Yeah, I'm just giving it. Out of this 87, 30% represents these two new brands, that is Bond Street and the Athleism.
Right.
And rest is the red tape.
Okay. So could you also give details on working capital?
Working capital is a little higher because of our expansion in the domestic side. We are increasing our these online shops. Right now it is 23. Our plan to increase 25 more shops in next 3 to 4 months. So that requires a capex. Each shop requires a capex of somewhere around 50 to 60 lakhs in the infrastructure and additional inventory of 50 to 60 lakhs. So fueling this growth, we have to increase our working capital. So right now, that's why our total loan is 300 crores as of 30th June 2018.
So majority of 300 crore will be to finance working capital, if I'm not wrong.
Yeah, out of this, the term loan is somewhere around 40 crores. The rest is the working capital.
Right. So if I could squeeze in another question, how much are we sourcing from China currently?
In terms of number of pairs, honestly, I can't give you a number now because the government has increased duties, so we've started sourcing from other avenues. But honestly, I don't think I can share the exact quantity of how much I'm buying from China.
All right, sir. And so in our clothing business, how much markup do we...
No, again, that's something I can't answer, how much markups I'm doing.
Right,
actually, in all our branded side, we are getting the EBITDA of somewhere around 17 to 18%.
Okay.
In the branded side, the same EBITDA is there.
Right, sir. All right, thank you. I'll get back in.
Thank you, ma'am.
Thank you.
Thank you. We have a next question from the line of Yogansh Jeswani from Mittal and Company. Please go ahead.
Hi, thanks for the opportunity, sir. So, sir, I wanted to understand now that we are focusing mainly on the online store. As you mentioned, most of the new stores that we have opened are online format. And the next leg of growth is also coming from the e-commerce store. So, and you have been telling that online stores have been on a discount format, right?
Yeah.
Hello? Yeah.
Yes,
so
yes.
How does this kind of expansion affect us on the gross margin front? Because these are heavy discount avenues from what I've understood over the commentary that you have given so far.
No, so if you look at the discounting of these online stores, that really doesn't have any effect on our gross margin simply because that's a different cost structure. Online stores are not opened in high, expensive, prime real estate. They open on a lower quality areas where the rents are lower. And these are bigger shops. So my per square foot shop of running the shop is lower. And the overall structure of the product, the buying price, the multiples, everything is adjusted in a way that we get similar margins.
Okay, so basically margin profile of an offline store or an online store is no different. It's because of the product placement that we have that we are making similar margins in both.
In fact, the margin profile has to do more with how successful a certain store is. There could be one online store which is making more margin than an offline store. And there are also some offline stores which are losing money. So it all depends on the situation of that independent.
I'm on the gross margin, so that won't take other overheads. Right?
No, so gross margin also changes because if something doesn't move from a store fast, then automatically we have to reduce the prices and then immediately my gross margin changes. If I have an offline shop and the movement is not good, after a certain amount of days, we have to keep reducing the price to get rid of the inventories.
Understood. So my second question was also on the similar line, so I'll put it up front. So basically, say for example, if some particular segment or product we have that's not moving in an online store, so does that move between other channels as well, that we'll try to put it on e-commerce or even get it on the offline store and try to
move it in between? Online stores, whatever we put in online shops does not go into offline shops. But all my online shops are connected to e-commerce because every single one of them are actually live on Paytm and a lot of other portals.
Mm-hmm.
So if let's say you're living in Amritsar and you order a shoe, probably you will be that online shoe will go from the Amritsar store to your shop.
Okay. And so like you mentioned that we start slashing down the prices when we see a product is not moving. So what is that threshold that you have for an inventory when you realize, okay, this is not moving and it has its own sweet time now, let's cut prices and sell it off. So what is that threshold for you? And
there is no rule in retail. You have to change as per the situation every day. And we thrive on market intelligence and how fast we can change ourselves. Normally, let's say if there is a product that's not moving in a certain area for 3 to 4 weeks and we notice that the movement is not good, and we notice that the movement is good on either an internet platform or in some other area, so we shift the product or we send it to that. But if the product is a complete failure, let's say after 4 weeks, then we devise a strategy of how to liquidate it fast.
Okay. Understood. So, and so secondly, as you have mentioned that we have these growth plans of opening another 25 stores. So, given the balance sheet stress that we are having, that now we are at 300 crore debt, so, and the inventory days also I understand will be higher going forward because we are from manufacturing 2 stores in the leather side and then we are sourcing on the garments and the sports.
Right.
So obviously our inventory days would be higher, so it would put a stretch on our balance sheet. So
no, it won't. No, it won't. And I'll tell you why it won't. Because the next 25 to 30 stores that I'm opening are going to open in the next 2 to 2.5 months. So that inventory that investment is already done. Those shops are under construction. The inventory has already been bought. So now the cash is going to be generated.
Actually, we are focusing on these online stores and the retail stores.
For example, right now in the next 10 days, I'm opening 9 big shops. So all that investment which you see in our books has already been done for those stores. The product has been bought, the capex has been spent, everything is done. So I think in the next 2 to 3 months, you will notice that the inventory days would start reducing then.
Okay. So currently, I think we are around that 180, 190 inventory days, if I'm not wrong.
Yeah.
So on a normalized basis, once we have normalized all our operations, what is the kind of inventory days that you are looking at, or what is the kind of days that you think should be a good enough for a player like us?
3 months, but that won't happen. So I think it will be safe to say around 120 to 140 is what we would want to achieve.
120 to 140.
Yeah.
Fair enough. Okay, sir. I'll get back in the queue.
Thank you.
Thank you, sir. We have next question from the line of Pratyush Mittal from Mittal Analytics. Please go ahead.
Hello, sir. So I would like to follow up with the previous question about the inventory days, about why is this number so high? Like the average inventory days across the industry retail segment is somewhere around 60 to 90 days. So why is such a high number?
Pratyush, there are 2-3 factors. One factor is that we are at an expansion stage. Normally, when we order footwear or garments, it takes about 4 to 5 months to get them to your stores. And we were targeting about 40 to 45 shops, large format ones, to open in August. But due to certain factors, like India is an unpredictable country, There were certain disturbances at certain places. It was raining in Northeast, raining in Kerala. So a lot of these shops got a little delayed. That's the reason why you see a higher number of inventory days. Coming to the second question, if you compare a hardcore retailer to us, we are not a complete retailer. Even today, a lot of my revenue comes from distribution as well as shop-in-shop model. So there, the numbers are drastically different from being a pure retailer. So we are a combination business of multiple things. That's why our days are slightly higher.
Okay. And like the number of stores which are targeting of 45 has reduced to 23, like how much of the inventory can be allocated to this number, to these 22 stores that we are not planning to open over next 2-3 months?
No, sorry, I didn't get the question. You said the number of stores have been reduced to 23? I didn't get that.
Yeah, like we were planning to open 45 stores, but now we are planning to open only 23 stores over next 2-3 months.
No, I didn't say that. We are planning to open 45 stores. 23 of them are under construction, which are going to open now, out of which 9 are opening in the next 10 days.
Okay.
In fact, one is opening today in Bangalore in HSR layout. There's one opening tomorrow in Siliguri. So I have got a schedule of next 9 to 10 stores opening right now in the next 1 week to 10 days. Another 10 to 12 stores should be opening in another 10 days. But by January, we are definitely targeting more than 45 stores.
Okay. So that target hasn't changed.
Yeah.
Okay. So about the change in sourcing, for example, earlier we were sourcing from China, but now we are planning to source from Bangladesh and Vietnam. Like, who owns the designs and how do we maintain the consistency in quality? Are the designs our own or will the designs also change? How will this change take place?
See, design development is all ours. The quality control is ours. The sourcing of materials is ours. When the government suddenly put a duty in the middle of the financial year, we have to change ourselves because we can't go from 10 to 22% overnight. So that's the reason we moved to areas where there's lower duty. It doesn't make sense to pay high duty.
Okay. Thank you, sir.
Thank you.
Thank you, sir. We have next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. My question is also on the same lines as previous participants. While you've done tremendous job in terms of focusing on domestic market and growing it, the worry is on the inventory side again. And I'm referring to your full year numbers where the inventory has gone up by more than 100 crores and our domestic sales have not grown so much. So, my question is, are we carrying almost a year's inventory in the domestic market right now? And what is the game plan to bring it down over a period of time?
Okay, I'll answer that. So, to sell, we need to buy first. And the current scenario in retail is that we are going through an off-season patch. Now the season is starting. If you see, last year we did a turnover of 390 crores, and this year I'm targeting between 600 to 650 crores, which is substantial, quite big from last year. So for that kind of numbers, we need to have the right product in. And if, let's say, in the Indian market, the season opens after 15th August. 15th August is usually the date when all the sales end. So you need to buy heavier inventories earlier. You can do the QCs, get everything sorted, do the allocations. It's better to have extra inventory at the beginning of the season than to have less inventory and lose out on opportunity in your stores and end up in loss of sale. I think because we are in a phase of expansion, a little bit of tweaking would be done in future where inventory management would be better. Currently, the reason you see the inventory days going up is not because we're carrying a year's inventory, it's because we're targeting a higher sale in the next 6 months.
And we have
you have stocked up in March. The season starts on 15th August. So I'm referring to the March end number because that balance.
If you look at the March end number between March end and July in that quarter, if you see the first quarter, we have already grown by 27%. And this right now, the way market is growing, I'm targeting anywhere between 50 to 60% growth.
Mr. Shudha,
yeah, but see,
we have also we have also introduced a lot of models, and we have to feed a lot of channels. We are in the online space. His
question is why were we stocked up in March? I'll answer that. The reason is because
I understand and appreciate what you are doing. My question is, what should we model and what is the return on investment that you are making? What is your ROC for this retail business? Ultimately, it boils down to that question as to, are we investing so much money that the return on investment will not be seen?
No, actually the thing is that currently we are in the growth phase. That's why the inventory and working capital is on the higher side. But after 2 or 3 quarters, as this retail business is growing, it will generate a lot of cash. So this working capital will be settled. So let's just wait for 2 or 3 quarters. I think it will come down to a recent level.
Shujya, why I'm pointing out this is because I'm actually a big fan of what you have done, and I've actually gone and seen a store in Zirakpur and bought material from there. But the message that market is giving you is that the stock price has actually fallen in spite of your performance being very good, and that's primarily because each one of us on the call has expressed concern on the inventory and also on debtors. Last year also the debtors...
Your question is absolutely valid, but sir, I'll tell you the real reason. I've understood your question. When we order in India, we can't order every month and put product in every month. It's a seasonal thing that happens once in 6 months. I get 2 shots to put product in the market. One is generally in early March, and the second happens early September. So the early March, the inventory was planned. In that inventory, we had planned additional 23 stores that were supposed to open now, as in they were supposed to open in June, July. That inventory was bought. But because of various things that construction made, in India, opening big stores is not an easy job. Things get delayed sometimes. So because of all that, the inventories got a little excessive. This entire problem will be sorted within the next 1 to 2 quarters.
Okay. Thank you very much. All the best.
Sure. Thank you.
Thank you, sir. We have next question from the line of Gaurav Lohia from ENR Advisors. Please go ahead.
Hi, Shreya. My question is that is there any other company domestically or globally who is following this online store concept format?
Yes, there is. Alibaba.
And is
there a store called Hema. And that company is only in China. They have 1 store in Shanghai. And if you see, our stores are powered by Paytm, so they are our technical partners. And when we started, we actually went to Alibaba and we saw the entire setup. And Paytm helped us integrate the whole thing. And this concept in India, we are the only people.
Okay. And since we are doing it on large scale, then, you mentioned Alibaba, and there is no other company in India doing the same. What do you think that could be the challenges in, going aggressively on that format? Do you think that, let's say, if you open large number of stores, our existing stores would also get that image that, Red Tape is a discounted brand and probably we should buy only when there is a sale on those stores, and probably that could affect our margins or maybe sales on those stores?
No, honestly, the margins in online stores are not bad. The margins, in fact, same as offline stores. As I said, it all depends on which store is doing what.
No, sir, I wasn't talking about online stores. I was saying that, let's say, if you open too many stores, let's say there's one store in Gurgaon, Sector 14, and there's another Red Tape, smaller store in that area. Okay, so when I go and see that large online stores, next time if I see a smaller store, I would not buy any product from them because I would think that, unless there is a discount which I'm getting at online store, why should I be walking into a smaller Red Tape store and buy from them?
Yeah, I'll answer that. The stores that, like you mentioned in Gurgaon Sector 14, the large one is an online store. The smaller one is a discount store. So what we used to have earlier was, we used to have in higher quality markets, like if you go to a good shopping mall, you would see a nice, fresh Red Tape store selling a different product line. And we had discounted shops like the one which is in Gurgaon. That was in any case selling discounted product. So what we have done is, instead of having a 500 square feet discounted shop, we've now decided to open 4,000 square feet ones. Because we believe that the size of discount market, which is in areas outside the city, is very, very big and is completely untapped. So there is no conflict. A person who's living in Karol Bagh can go, I've got 2 showrooms in Karol Bagh market, which is center, high quality shopping area. If you want to buy discounted, you need to go towards Pritampura, which is about 40 minutes drive. Right. And there is a customer for both, honestly. There are people who want to buy fresh.
I was just asking, when we decide on location, do we look at that there is no existing red tape store, which is not discounted one? We
look at that there should be no sales compromised of a fresh store. Until unless we feel that that area is not a fresh area and we should close down the fresh area. Like, for example, I'll give you an example. In Kashipur, we realized that the fresh store is actually not performing well. So we turned it into a discounted format. So we keep that balance and we know how to, keep it.
Okay. And when we turn a fresh store into a discounted one, we make sure that the margins remain the same. So I would probably increase my prices and then offer a discount on that one, right?
No, we don't do that. We have a different price. We have a different product altogether.
Okay, so we change the product portfolio altogether.
We change the product. The product is built accordingly.
Okay, all right. And so, what could be the challenges in growing the domestic business? Let's say, now we have achieved a certain scale. There must be some challenges, as in, I don't think that we have had too many of hirings at senior level or all those things. So do you think, what could be the challenges? And, on the supply side, there would be something that we need to work upon, right? So if you can throw some light on that.
There is honestly, there are multiple challenges. One challenge is that the government changes policies overnight. So your entire planning gets disturbed. Normally they should do it during the financial year once in a year or something, or, they should announce it before. And the second challenge which I feel is now becoming a challenge.
Give an example of this policy change that you were just referring to.
The duties. When the duties change, and they change in the middle of the year, suddenly one day it was announced that the duty has gone from 10% to 22%. So retailers like us have to then run around and look for other sources. So these are just disruptions. These are things that slow down your pace and make you do other things. So this is one of the major challenges that we're facing today. Even yesterday there was another policy that was announced, day before yesterday, in many items that the government has decided to change policies. So that's the problem.
So this is the only risk that you foresee, the government policy?
This is one of the biggest risks I see right now. Otherwise, I don't really see many risks.
Okay. And so, we are dependent on Bangladesh for this apparel import and all. Now, I think day before yesterday, there was a news, right, that the government is thinking about putting import duty on textile imports and all that, So, are we taking any proactive steps to...
no, I'm not taking any proactive step. Because when the government does it, only then I can take a step. Government is thinking a lot of things. And if I start thinking what they're thinking, then I'll be in a different zone altogether. I don't do that. When the rule comes, then we'll figure out what we have to do.
Okay. Because that could really hit our apparel business, right? So we should probably be, anticipating...
How will it hit our apparel business? Everybody is sourcing from Bangladesh, and it will hit the entire industry. Then we will start sourcing from India or wherever the exemptions are. See, we have to move with the policy.
All right. And the last question would be, what's happening on the export business? That's really taking a toll on I would say that even though we are growing very good or very rapidly in the domestic business, but the growth in the earnings is not there because of the export side. So if you can throw some light, we have been mentioning that retail market in UK has been slow and all that, but, it's been declining for last 2-3 years now and at a rapid pace. So there must be
I think this quarter would be probably the last quarter where you would see export decline, because the current quarters we are expecting it to be better.
Okay. So probably from here onward the decline would not be there.
It should be. I think there should be no more decline. In fact, we are targeting a growth of 5% in the overall year this year for export.
Okay. So we'll have to grow significantly in the next 3 quarters to be able to make
Yeah.
Okay. All right. Thank you, Shrija. Thank you very much.
Thank you.
Thank you. We have a next question from the line of Yash Agarwal from Crest Capital. Please go ahead.
Hello.
Yeah.
So,
hi, Yash.
Yeah, hi. My question is also on the export business. So, from a 2-year basis, quarterly, we are down from 152 crore to 107 crore. So, for the full year, what sort of revenue are you targeting? And, which are the geographies which are contributing to it, in the export side?
Right now...
So you shall take it.
Yeah. Now, currently 74% of our total export is coming from the UK.
Okay.
And 15% is contribution made by the US. Rest is from the rest of the world. And
so which is the major market which is seeing the most decline is what I was trying to understand.
If you talk the number, UK is the most declining because it's the biggest market.
Okay. So what is the outlook here, in the next 1-2 years?
Going forward for the year, for FY19 as a whole, we are targeting a turnover of somewhere around 550 because we are expecting a growth of somewhere around 5 to 6% in this export on an annual basis.
And this will remain here only, or this has scope to increase in the next 3-4 years?
No, of course. In export, everything changes after every 2-3 quarters, but we can only comment about the next 2 quarters because it's a private label business. This is how we can see it happening.
All right. And my next question is a slightly bookkeeping question. So in the segmental data, I see the branded margins have shrunk year on year. Is there any reason for that?
The branded margin is, I think, stable. It's at 20% on quarter-to-quarter basis.
Yeah, quarter-on-quarter it's flat. But year-on-year it shrunk.
If you compare from the first quarter last year, in the first quarter last year, we were having the advantage of working from the Haryana, which was on the lower VAT. The VAT was 5%. So that was the extraordinary margin we get on the last to first quarter. Thereafter, you see there is the margins are somewhere 19-20% on quarter-to-quarter basis.
And for the full year, for the whole business as a whole, what sort of EBITDA margin should we, build in?
17 to 18% should be the range.
17 to 18%. Okay. Thank you.
Thank you.
Thank you, sir. We have next question from the line of Alisha Chabra from Securities Investment Management. Please go ahead.
Hi, my question is that the export is falling every quarter, even when the currency is supporting. So what is the key issue here, and do we have any competitive advantage in exports market?
Alisha, see, the thing is that currency is not really supporting us because we forward book all our currencies. And every time currency goes up or goes down, the price gets adjusted accordingly. When we are looking at the currency prices, so are our buyers. So those things really don't make much difference. As far as competitive advantages are concerned, we are one of the largest exporters out of India. We are very, well established. This is not the case with us that the export has fallen down. This is across the entire industry. If you see what's happening in Agra and Kanpur and other places like Chennai, you will notice that overall industry exports are lower by much higher figure. So this is something that it's a macro level thing rather than a micro level.
Okay. The next question is that same on tannery division, sales have been falling. You mentioned in your previous call that you could see some upholstery sales, but nothing has come up. And although the margins are increasing, but there is no sales growth in leather division.
Upholstery sales is getting the traction. We are getting the goods order. In the next quarter, you will see the improvement.
Okay. And what is your e-commerce growth brand-wise?
E-commerce growth is, for this quarter, we have grown by 49% in this marketplace model. And our turnover was 24 crores in last year first quarter, and this quarter we have achieved 49 crores.
Okay.
So there is a tremendous growth.
And which brand has contributed the most?
For the domestic branded business as a whole, 30% of the footwear comes from this Bond Street and the Athleisure. These are the two new brands we have launched last year, and the rest 70% is coming from the Red Tape brand.
Okay. And what is your export utilization currently, and do you see the current 13.14% EBITDA sustainable?
Yeah, in the export, I think it is sustainable. 14 to 15% we can easily sustain.
And what is the current export utilization? I mean,
in terms of?
In terms of your capacity.
Capacity is in exports we are using somewhere around 78%.
Okay. And we have seen that the gross margin in the overall business has been declining. So what is the reason for that?
Actually, there's a couple of reasons. It's because of the sales in different channels. We make the sales in the wholesale business where the gross margins are very lower, but there are no cost below the line. But if we take the sales of the retail outlet, the selling price is higher, but we have got the gross margins are higher, but there is a cost below the line because the cost is like rent, the commission. So that's why it's because of the mix in between the channels.
Okay. Okay. Thank you.
Thank you.
Thank you. We have a next question from the line of Avik Mitra from Investors and Financial. Please go ahead.
Yeah. Hi, Shuja and Mr. Awasthi. Thanks for taking the question.
Okay.
Hi. My first question is basically if you can give me a broad outline about your risk management policy, and if you can tell me exactly what is your inventory as on date and what is the age, and what are the inventories more than 6 months and 1 year old?
Total inventory as on 30th June is somewhere around 397 crores.
Okay.
It means it includes the inventory from the tannery, from the export business, for the domestic business. The complete inventory is 397 crores. And for this non-moving inventory you're talking about, what we do, we don't keep the non-moving inventory for maximum 6 to 9 months. After 6 to 9 months period, we just keep clearance of this non-moving inventory. We don't have any inventory which is more than 9 months old.
Okay, so now presently what is the, say, inventory which is 6 months old vis-a-vis, say, 3 months earlier?
So, actually, the percentage of this inventory for 6 months to 9 months between, I think it will be maybe around 10 to 15%.
10 to 15%. And this trend is always the same? Like 3 months back also it was about that?
Not the same. It keeps on changing because once we have launched the model which is not working, then it comes to in this jurisdiction. Then we start how to get rid of this inventory. So we take this stock to this online marketplace model. So we have to sell this inventory in different channels.
And can you tell me, you must be having some MIS about the percentage of inventory you sell below cost?
Actually, that
percentage of inventory that we sold below cost.
Yeah. Are there any inventory which is sold below cost?
Normally, we sell less than maybe 0.25% or something, which are basically shoes which are rejected or something goes wrong with them, which we sell below cost. And that usually goes to, we don't sell them in any of our channels. It goes to these people who pick up stock lots.
Okay, so generally nothing below cost.
No, we don't sell anything below cost.
Okay.
Only if there's like a consignment which has come back or something, or defect or something, which is very unusual.
Okay, and since you are growing so fast and so impressively, so can you give me what are the plans for your second line management to take up this marketing and this entire pan-India exercise, which is, I think, pretty different from what you did till now, till say 2 years back. So what are your plan of organization building?
See, the thing is, for the last 2-3 years, I've been looking at the domestic business completely, and we have teams placed in different regions. Like, for example, South region for us is very weak. And I have put in a full team there, and we are now focusing on states like Kerala, Andhra Pradesh, Telangana, Tamil Nadu. So we have a lot of geographical areas that we did not actually explore, like the Northeast. I did not have a single store in entire Northeast, that including West Bengal. So it was like a full, half of India was not touched. So we realized that our risk is not really increasing in terms of doing anything new. We're just expanding into new geographical locations.
Yeah, but
using the same formula.
Yeah, exactly. But the scale requires a set of manpower, right? And quality.
Yes, we hire manpower all the time. We have a lot of people that we've hired. If you see our audited results this quarter versus last quarter, same year, the entire salaries have gone up in a very big way because simply we've hired a lot of manpower.
Oh, it is because of the increase in the number of employees from 20.
Yes, we've got a lot of heavy number of employees that we've hired. We've opened new offices, we've opened new branches. That's the reason.
No, actually your salary has gone up only about, I think, less than 10%, about 10%. So I thought it is an annual increment or something like that. So
no, that's a lot, because if you look at all the shoe factories, all the tanneries, everything put together, then the salary has gone up. In fact, in a domestic business, we have been hiring a lot of people across the country.
So any people below you actually who actually looks after this as a...
everybody's normally looks at this in different regions. Like I was South Manager.
What is the organizational structure actually below you? That is what I'm trying to understand.
We have different regional heads and different, like we have a retail head, online head, then we have offline store heads. So we have divided different businesses, and then each business has one team leader who runs the entire show and who reports directly.
Okay. And what is your present receivable compared to last quarter?
Receivables are around 160 crores. As compared to last year, it was 130 crores in the same quarter last year. Last quarter, it was 130 crores.
And just for recollection, what was the last quarter inventory? I don't have the data right in front of me.
Inventory is 380 crores as on 31st March 2018.
Yeah, okay. And Shuja, there is a question for you basically because last quarter con call you were not there and there was some questions asked about the corporate guarantee and the promoter salary and stuff like that to a wrong person.
Right.
Mr. Awasthi.
Right.
So if you can give some light on this actually, I think Mr. Awasthi may have updated you on that. So
yeah.
Because many callers actually ask the same question that what is your plan going forward? So because these unusual structures, would you keep it or for the sake of investor community, you can get rid of these over a period of time?
No, of course, we want to get rid of them over time, but these structures have been there for a long time before I even joined the business. So, I'm trying to get the management. Yes. So I'm definitely working towards the housekeeping of all these things, and we are discussing internally, and slowly we will transform this company.
Excellent. Thank you so much. I think that's all.
Thank you, sir.
Thank you.
Thank you, sir. We have a next question from the line of Zakir Bas Nasir, individual investor. Please go ahead.
Yeah, good afternoon. I have two questions. One is regarding, sir, what would be your percentage on sales of manufactured to outsourced goods?
Right now the percentage is somewhere around 55 and 45.
55 is own manufactured.
55 is own manufactured. Traded is 45, including the garment, because the garment is 100% outsourced.
Acha, garment is 100. And do you have any plan of doing your own garments in the future?
No, we're not.
Acha. And sir, in the same light, what would be the percentage of leather versus non-leather? Because you've started some PU shoes and sports shoes and all.
Actually, so it is 30-70. 30% is the revenue coming from this athleisure and this Bond Street. Bond Street is a non-leather, athleisure is sports footwear.
Okay.
And the rest is all leather. So that is 30-70 is the ratio right now.
Okay, fantastic. And sir, as someone else also pointed out that over the past 2 years, Mirza has slowly been transforming into a brand, actually a solid pan-India brand. What would your broad and which is obviously evident in the way your domestic sales have grown. What would be your view of your company in 2020? How do you foresee it, sir? Thank you.
Honestly, my targets are always very aggressive. And I've always been telling people numbers which they find it hard to believe. My target for 2020 would be somewhere around 900 to 1,000 crores for the domestic business, red tape business in India. As far as exports are concerned, I feel that if we do reasonable, we should be able to get to at least 700 crores. So that would be around 1,700 to 1,600 to 1,700 crores. Overall.
That will be fantastic, sir.
Yeah.
Because the brand has really established itself, and you're playing the online game also pretty well. And let me tell you, your designs in the category of sports shoes are very good. They are comparative to the international brands.
Thank you, sir.
Thank you, sir. We have next question from the line of Shailesh Kumar from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to know how has been the response of the market for this women fashion footwear brand Mode which you have launched and women sports footwear under Red Tape brand?
So the women's sports footwear is selling very well. And it's already, we're selling online properly and offline everything. The Mode, we already got a very small window right now. We've only had it in the market for about 3 months, less than 3 months. Okay. So far, the reaction is good, and we are now planning other inventories. So it's at a very nascent stage, but I can see light at the end of the tunnel, so I think it's going to work.
On full year FY19 basis, what kind of revenue are we expecting from these new categories like Bond Street, this athleisure, and all the new launches which we have done last year onwards?
Yeah, 30 to 40% will be the share in the total branded size.
So that would be 30 to 40% of 600.
Okay. Though, Suja, you have anyway highlighted that you are doing your best to address this corporate structure issue. One thing, I have been asked by many of the investors, with a balance sheet size of, say, close to 600 crore, why do we need a promoter's guarantee for any kind of bank borrowing?
Actually, right now the bankers have given us the condition that they will give the loan only when the promoters personally guarantee. This is a guarantee taken by the bankers. And right now, you know the status of the bankers and what is going on in the banking sector. So they are not agree to remove this condition. That's why we have to take this.
Okay. Some bookkeeping question. What is our targeted working capital days for FY19 full year basis?
For FY19 full year basis, I think we are planning to just reduce it to somewhere around 150 days.
150 days? Okay. And what is the tannery capacity utilization in Q1 FY19?
Q1 it is somewhere around 55%.
55%. And how do we see it on full year basis?
On full year it will, go to improve to, I think, 65.
Full year it is
6. It will come down 60. It will reach to 65%.
Okay. And what is our cost of working capital loan?
The average cost is somewhere around 8%.
Okay. Fine, that's it from my side.
Thank you. Thank you, sir. We have a next question from the line of Manoj Dua, individual investor. Please go ahead.
Good afternoon, sir. Last 2-3 years, you decided to expand your domestic business. So, the company is in transformation stage, growth stage. Definitely some inventory will go up, working capital will go up. But when you visited with Alibaba and Paytm, where do you see yourself after 5 years? Where you want to position yourself, which kind of company you are? Most of it will be coming from online store. Of course, you channels. But where do you see after a long term, what is the game plan so that we can track you from that perspective?
See, my long-term game plan is I want to make Red Tape a very serious international footwear brand. And right now, we feel that in India, we should first focus, because there's a lot of untapped market lying literally for us, which we had not touched. As I said, by 2020, I want to be somewhere around 900 to 1,000 crore rupee vicinity for Red Tape domestic business. Then we would want to start expanding in international markets close to India, like Thailand and Malaysia, Middle East, and also in Europe. I want to take Red Tape, I want to make it into, let's say, a Nike or a Adidas. That's what my final goal is.
Okay. Does this discounting model give a little bit less attention to the people? Most of the sale is coming from a discount model. That can we take it as a different mass segment product, or Nike product is a little bit of premium and they want to keep a little bit of scarcity, like to go for such this?
Sir, I'll be very honest to you. The of Nike in India and what you see in the rest of the world is completely different. Nike is not doing a great job in India, and they haven't really taken over any of the market size. If you go to America, which is the largest market, you come out of any city, you will see massive, larger-than-life Nike stores on every corner. They might have one shop in San Francisco which is selling Nike sports at fresh prices. They'll have 20 big stores outside San Francisco on the outskirts, on the highways. So overall, the model worldwide has changed towards heavier discounting. This is what people like. If you tell them there is no discounting and this is a lower value product, they think it's cheap product. So I can't change the culture, but we can change ourselves to fit the culture.
Agree. So we are the first one to create a give big company to create like structure like this, and definitely
no, we are not the first one. In India, already a lot of brands are doing. Puma is doing it in a very big way. Puma is even a bigger player than us in online sale, and they do a lot of shoes online on discounting. If you see a couple of years back, there were a lot of Reebok discounted outlets all over the place. So all these international brands are doing it. But because now we are doing it, so we are more in the limelight.
Yeah, as an investor, we are tracking this company more closely than other company. I understand that. So, what are the advantages we are getting because of the GST 1,000 rupees has going to 5%? We can
Nothing. We are getting no advantage as such because that law says that you have to print the value, and if it's not printed, then you don't get that advantage of 5%. As far as we are concerned, we really don't have any products under 1,000 rupees. Everything is above 1,000. So the only products that were selling on discounts were going below 1,000. But we can't get 5% GST because the product is not printed with 1,000 rupees. So honestly, it has no impact on us.
Okay. Last question. When initially now the inventory is high, I mean our sales will be higher. We can place order from companies in a regular month basis. We can purchases. We may buy for more correct time if we have a bigger timeline, a bigger sale. So in longer term, how do you see the ROC of this business? Because initially, your ROC was very good. So I believe that management is concerned that we should make a good money of the capital employed. So going forward, not this year, maybe not this year, how do you see this return on capital employed on this retail business?
Yeah, it will increase by 2-3% in the coming 2 to 3 years.
The number, can you have some number thing on that?
I think maybe between 17 to 20%.
17 to 20%.
Yeah.
Okay. Thank you.
Thank you.
Thank you. Participants, please restrict your questions to 2 per participant. We have a next question from the line of Pratik Chaudhary, individual investor. Please go ahead.
Hi, Shuja. Hi, Shyamji.
Hi, Pratik.
The expansion, the retail expansion that we're doing, I'm sure there are a lot of risks also involved with this, because a lot of companies that who have done it this aggressively in the past have had problems for themselves. And so strategically, in terms of the risks that you are entailing with this venture, what are your thoughts on that? And second, how do you look at the profitability per store in such a format? Because if you look at the products, the product range is completely different from, the product range that you're giving out in an online store is different from what is usually there in an offline store. So from that perspective, even though your other overheads that you talked about, that the locations are at places where your overheads are not as much, but the gross margins here then become very important. So if you could give some light on, is it whatever you sell in an online store, which is where your next leg of expansion will be, do you sell it at 60% gross margins? Is it 50%, 40% or 30%? Because, that range changes the complete story as far as per store profitability is concerned. Because as you said, your overheads in these large format stores on a per square foot basis are not as large. So what's the gross margin like here and the profitability?
See, you have asked multiple questions. The first question is, how do we track our profitability? We have ERPs installed everywhere. We know exactly how much cost of goods we are selling and how much is the cost of running that store. What are the overheads? How much is the interest depreciation? We monitor it every month on month, very aggressively. As far as gross margins are concerned, I will not say that in any public platform, because those things we are keeping to ourselves right now, simply because a lot of our competitors are trying to figure out what we are doing. Yeah. And see, I can't go into too much of detail because some of it is of our trade secret. But to tell you in a nutshell, our margins in online stores and in our offline stores are same.
At the EBITDA level, we target the same margin.
At the EBITDA level, will be the same.
Segment.
Okay. And and the risks that you foresee in such an expansion?
The risk, there are multiple risks. When you're expanding into new territories, there could be a risk. Biggest risk is, what if the shop doesn't work?
Yeah.
I always look at that risk. The biggest risk is, I open a store, I put inventory, do everything right, but the customer doesn't walk in. So that's the big risk that we have.
have been of the 23 stores that you have opened till now, have you had any failures of that kind?
Yes, one failure.
Okay. And so have you?
I'll tell you the failure also. We had one failure, which is in Delhi near the airport. One day the government decided that they want to stop those stores from functioning. I've seen that area with stores since I was a kid. I'm 37. I've seen it all my life. Suddenly they decided to close that entire road. So these risks are always there, but that doesn't mean we stop doing new things.
Right. I understand.
Okay,
thanks a lot.
Thank you. We have a next question from the line of Ashish Agarwal, individual investor. Please go ahead.
Hello, sir. Sir, how Paytm is helping you establishing online stores, sir?
They are our channel partners. We do omni-channel with them. They are our technology partners, and we work very closely in designing the entire systems.
Okay, and what kind of royalty per store do you pay to Paytm, sir?
So that's something that's only between us and Paytm, because we have a different relationship with them.
Okay, and one more thing, sir. Like, how much advertisement cost in this quarter, sir?
Sure, that cost. Hello?
Hello, sir.
Yes, can you hear me?
Yes, sir, I can hear you.
Yeah, so Shyam Murthy had already mentioned the advertising cost. Shyam, are you on the line?
Okay, sir, one more question, sir. So, like, we have not seen any type of advertisement in terms of women accessories, shoes, etc. Hello?
Sir, please stay connected. Seem to have lost the management line. Please stay connected. So we are back in the conference.
Yeah, sorry, the lines got dropped. Yeah.
Sure. Sir, we had the last question. Shall we?
Yes, the last question was the advertising cost. Shyam had already given it at the beginning, and I'm not able to locate Shyam on the phone. So, hello?
Sir, yes. Shall we conclude now?
Yeah, I think we should. Right.
Sure. Sir, do you have any closing comments?
I would like to thank everybody for joining us for the con call, and I hope we have answered all your questions. And in case there are any queries, you're always welcome to email us, and we should be able to give you a prompt reply. Thank you.